I actually had a mentor. He was my economics professor, and he used to literally pound the table of his or the desk of it with his fist, and he used to say, "Earnings determine market price. If you overpay, you really put yourself in a position where you made the right decision to buy the right company, but you didn't make the right decision paying a fair price for it."
I am chatting with Chuck from Fast Graph. He's officially the youngest person that I'm interviewing on this podcast. So, Chuck, thank you very much for joining me.
My pleasure. Thanks for inviting me.
Okay, so let's talk about your investment style. Your YouTube channel is Fast Graphs, but I think you're a value investor. Am I right?
Yeah, actually, I used to write quite prolifically on the website Seeking Alpha, and I had followers there, and they ended up dubbing me Mr. Valuation. So that's kind of a label that stuck. And I am a value investor in the purest sense. I predate things like modern portfolio theory. Excuse me. I go back when we talked about investing based on growth, income, aggressive growth, moderate growth, dividend income. So I'm kind of old school in my teachings and beliefs, and quite frankly, after more than 50 years, I've never had any reason to change. I believe that all investing ultimately is value investing. And it's not that anything else is bad, it's just that it's not, in my purest definition, value. And to me, value investing implies evaluating, if, for example, I'm going to be talking about stocks, obviously. It would apply to any asset class. But when you're looking at stocks, the critical thing, in my view, is to ascertain the intrinsic value of the business that you're contemplating investing in. I think, as Warren Buffett so aptly put it, people today know the price of everything and the value of nothing. And so I think, if a true value investor is trying to identify the true value of the business, and then that way, if they can invest in the company at or below fair value or intrinsic value, as I like to call it, then they can fully participate in the company. One of my pet peeves is people identify great businesses they want to own, and they'll identify them when there's a lot of hype around the business and the prices get ridiculously high, and so they're right on the business but they're wrong on the value.
Okay, so
Maurice,
I
I'm a
assume
value investor.
so I
Hardcore.
assume your investment style has been influenced, as you said, Warren Buffett, Charlie Munger. Is this how you started?
Well, I actually had a mentor. He was my economics professor in college, and he used to literally pound the table of his or the desk of it with his fist, and he used to say, "Earnings determine market price." And he had a study that Pershing had conducted, and it went back 50 years, and it correlated the S&P 500 to its earnings per share over that 50-year period, and the correlation was profound. And it was actually the mother of my fundamental analyzer software tool, Fast Graphs, the research tool I created, because in the long run, if you invest at intrinsic value, the growth of the business is what's going to generate the rate of return, as long as you're buying it at a good value. Now, if you underpay, or if you can pay below intrinsic value, you get additional benefits like PE ratio expansion. I call it natural leverage. And then, of course, the addition of any dividend income and dividend income growth you could receive. But I started out, my professor had a really great impact on me. And he had that on the S&P 500, but I, being a curious soul, I wanted to see that on individual stocks. So my wife and I, we were partners in the business. We started years ago, 50 years ago. We used to have to parse the data, and we were using, old archaic software programs, and it would take us an hour to draw a earnings and price correlated graph that became ultimately the fast graph tool we have today, with something like 80,000 symbols, that we can graph on it. And bottom line is, we found over and over again that there was this very, very clear and unarguable, in our opinion at least, correlation between a company's market price in the long run and its intrinsic value, over time. And as earnings grow, the price would grow. If earnings collapse, the price collapses, and so on. And the relationships are profound. So when we created the Fast Graph tool, the idea was it could show people whether they were buying a stock at fair value, if it was undervalued or being overvalued, and it helps protect them from making obvious mistakes. But I started out with my professor driving that thing home, and it really ended up becoming my life's work. And so again, we developed, it was the mother of the fast graph tool. But the whole idea here is to, about value investing in my world anyway, is that a true value investor is, identifying a great business. A stock value investor is identifying a great business, and then if they identify that great business, they want to fully participate in everything that business is capable of producing on an operating basis. And if you buy it at fair value, you get that. If you overpay for a stock, the business could do great, and you as an investor could do very poorly because you overpaid for the stock, and so on. So it became my life's work. And again, there are always exceptions to every rule, and there is a short run phenomenon that a lot of investors I think get confused of, and that's in the long run, earnings determine market price. In the short run, emotions determine market price. In fact, I started a money management firm, and I named it EDMP, which stands for earnings determine market price. But the evil twin sister is emotions determine market price, and that's where you get all the hype and hysteria, where people get caught up in a stock and they get the fear of missing out, and they chase things like, NVIDIA when it was running like crazy with the AI. They chase things like Eli Lilly when the semi-glutide got so hot, and they kept paying ridiculous values or prices, but ultimately values for these businesses, just because they were so excited about the prospects the business had going forward. But they failed to realize that if you overpay, you really put yourself in a position where you made the right decision to buy the right company, but you didn't make the right decision paying a fair price for it.
And so fast graphs, can you show us a little bit what this is?
Sure. Assuming I can make this screen share work, let's try. Let me bring up the tool for you. All right, we're seeing it here. This is
Yep.
this is a screenshot of our basic tool. And for example, I'll use a company. This was quite in the news here recently. This is Elevance, which is a managed healthcare company, and some people might be familiar with it. And let me just kind of briefly, if I can, just kind of illustrate what the tool is. And the best way for me to do that is to take it apart. So I'm going to take weekly closing stock prices off the graph. And the primary line on this graph is this orange line. And we utilize formulas to draw this. This is a plotting of earnings per share. And we plot it at a multiple. Now, for most stocks, or for a lot of stocks, we end up with a 15 multiple. And the PE ratio is a great tool for assessing valuation, but its real value lies in what I call the inverse of the PE, which is E/P, or the earnings yield. And what the earnings yield tells you is, if you buy a stock at a given price, that earnings yield is telling you, what your return on your investment would be if you actually owned the 100% of the company and they paid you 100% of the profits in dividends. So what you see here is a clear example of a company whose earnings have consistently grown, and then they flattened in 2024, and then they fell in 2025. And this has a lot to do with the big, beautiful bill for President Trump, and some of the changes that are made in some of the allocations of government funding to certain healthcare programs, Medicare, Medicaid, and so on. And so these companies are being hit with, this is the earnings growth of the company, and this company's average earnings growth from point A to point B has been 11.22%. So the slope of this line, or the rate of change of earnings, is really the driver of what your return is. You can buy a stock in value, and I'll show you an example, at a good value and not get a high rate of return if the company's earnings growth is slow. But if you buy it at value, and value would mean, and this is oversimplistic, is if the price is touching this orange line, the stock's at value, at fair value. If the price is below that orange line, then that would indicate a period of undervaluation. And if the market is pricing the stock above the orange line, that would indicate a period of overvaluation. So if I put weekly closing stock prices on this graph now, and this is going back to 2005, you see this correlation. Now, this was the Great Recession of 08 and 09, this gray shaded area. And, this is a time when stock prices fell, But if you'll notice in Elevance's case, they did have a minus 1% earnings growth in 2008, but their earnings held up very well considering, we were in a recession. And then they actually grew by 11% the following year, and then 11%, but the stock became very undervalued. You can see PE ratios here under 10, 8, 7. And the stock stayed undervalued, but then coming about 2013 or 14, we see that the price then hit intrinsic value, and then the market overshot that a little bit. All right, Mario. So one thing I want you to note, or any of your viewers to note, is this idea that in the short run, stock prices will be volatile. The most nervous line on this graph is the black line. That's weekly closing stock prices in this example. And when you get periods where the price gets below the orange line, it inevitably reverts to the mean, moves back to the orange line. When you see periods when the price gets well above the orange line, then it inevitably reverts back to the orange line. And you see that pattern repeating itself over and over again. Now, this period here coming out of the Great Recession this is very common for a lot of stocks. This was an area, a period of pessimism because we had just suffered the largest recession since the Great Depression of 1930, and stocks stayed undervalued for a long period of time, but yet they still tracked earnings pretty well, as you'll notice. And then as earnings began to grow and people's confidence began to come back, then we start seeing these periods where the stock price tracked earnings very well. Now, again, we see this company's earnings following stock price. And by the way, with fast graphs, for example, you could just use this to calculate performance. So here's a point where you're buying the stock just under the orange line. And if you held it when it was, before the collapse, you can see that it generated about a 13.5% rate of return. The yellow line, by the way, is dividends. This company started paying a dividend in 2011, and Fast Graphs illustrates that just instantly just by looking at the graph. Prior to this, it was a growth stock. And then you can see their dividend has grown every year, and the area below the yellow line is the payout ratio. So in this case, the company has a very low dividend payout ratio, which would imply there's a lot of room for growth for the dividend. But the company has produced great earnings. Now, it did fall into an issue here, and we see this very strong reaction to price. Price fell from a peak here, and I did hit it perfectly, down here to a trough. The stock's price has fallen 50% in just, since August of 2024. And we'll call it a year. But the reality here is the company's earnings only fell about 9%. As you can see that, from, looking at the rate of change of earnings growth down here at the bottom. So I would call this a dramatic overreaction. Now, the key is, if I see this stock as a highly undervalued stock today, and if you're a long-term investor, which value investing implies, it implies investing in a business that you want to own, for a long period of time, as Warren Buffett would say. And what you're looking at is, an opportunity here. If this stock, and this is if. Well, let's say I'm not going to worry about whether I hit top or bottom. Yeah, okay, I did hit the bottom. If you bought the stock today, yesterday's close, at a price of $275, and it did produce these earnings. Now you'll notice the light green shaded area are estimates. The dark green shaded area are actuals, and you'll see that by looking at the bottom of the graph here. The earnings in 2024 have no E on it. Those are actual, and I'm using adjusted operating earnings, by the way. And the estimate for 2025 is for earnings to drop 9% to $30 a share. And that's a consensus of leading analysts, and I'll show you that. And then they expect earnings to begin growing again by 11% in 26 and 27. So if it were to do that and it traded back at a 15 PE ratio, and this is a what-if scenario, investors would stand to make 36% a year if they bought and held the stock, and in the reversion to the mean that has happened so many other times occurred. Now, we also do produce a pure forecasting graph. And here you get some detail on estimates and analysts. There are 21 analysts that are forecasting the $30 per share for this fiscal year. 6 months ago, they were predicting $34.50. And that stayed as a pretty good estimate 3 months ago. And then the most recent estimate was for $34. And they have now updated that to $30. And that was based on guidance. And the company just reported earnings, by the way, I think it was the 17th, I think, the earnings came out. So this is a combination of guidance and these leading analysts. And this particular company, we also produce an analyst scorecard. This particular company historically when analysts were forecasting earnings 1 year in advance, this company has beat that forecast 18% of the time. They hit it 73, and they only missed it 9%. And the biggest miss was actually last year. And then with a 2 year forecast with a margin of error, they've had almost a perfect record. Now, all that tells me is analysts have been reasonably accurate on forecasting this company. So I put at least a certain, level of faith in the fact that these numbers might be correct. But at the same time, I also recognize that if there's one thing I can say absolutely about this graph is that it's wrong. Okay, analysts are not clairvoyant. They're taking a combination of guidance from the company and then applying their best judgments on the company's business and how it's operated and applying those numbers. So these numbers will probably be in error. In fact, when you see the scorecard, you can see that, like in 2016, analysts were forecasting $10.97 and the company actually earned 11. In 2017, they were forecasting 11.50 and it came out at 12. So Warren Buffett also said this. He said something to the effect, and I'm paraphrasing, he'd rather be, essentially correct than precisely wrong, I think was how he put it, or worse to that effect. So the idea is you use this as a guide, but it also serves as a calculator. So right now, the blended PE ratio is 8.82. So if it continued to trade at that PE ratio, and the company achieved these earnings growth out to this period of time out here, you'd still be able to make almost 12% a year. If the PE ratio, now the company also has a normal multiple, which is the multiple the market has applied that's slightly higher for this company. And on a normal multiple, this company can make 38% a year. So the tool allows you to basically evaluate a company based on, learning from the past, on history, and then focusing on the future. I also want to make sure, because people will say, well, that PE ratio is wrong. We also provide several other metrics. We provide diluted earnings, which are GAAP. Okay, and GAAP would include non-cash charges, one-time events, things that were essentially accounting conventions. So these numbers look a little different, and of course that produces a slightly different PE. If you go to sites like Yahoo Finance, for example, and look at a company, you will see a slightly different PE ratio than what we're reporting when you see the PE ratio, because they typically use trailing 12-month numbers, and they put that in here by TTM. And so they'll give, here we're looking at, they're saying the PE ratio is 11.9. We're saying it's 10.7, but we use what we call blended PE, which includes the past, the present, and a little bit of a forecast in there. So we're trying to just get a more accurate earnings estimate. Anytime you're calculating PE ratios, Marius, the reality is you're never using a precise number, because companies report earnings 4 times a year, and it's usually 45 days after the calendar quarter before the earnings come out. So when you actually see the number, the trailing 12-month number, it's already maybe almost a quarter stale. But the point is, you're trying to use this information as a guide. Now, we also then have metrics where we can look at the cash flow. Cash flow is very important on dividend-paying stocks. What I'm concerned about with cash flow, I often take price off the graph. I want to see the cash flow that the company's producing being higher than the dividend. So in 2024, Elevance produced almost $25 of operating cash flow to cover a $6.50 dividend. So that's really a nice buffer. The ultimate test is free cash flow. We use free cash flow to equity. I want to see free cash flow to equity covering the dividend, because free cash flow is what's left over after the company's paid all the expenses to run the business. And then we also have, this tool is also very comprehensive. We have, we provide people full financials. We have a fiscal fitness section where they can drill down and look at things like, we can of course look at sales, what the company's sales and what their sales growth has been. We can look at things like margins and look at, what their gross margins are. If it'll load, for some reason I didn't get gross, but there's operating margin and then net margin. And then we also have another product called Fund Graphs. I don't want to get too much into all this stuff, but it allows us to really get deep, dive into the company. We can also look at share buybacks, and with share buybacks, you can ascertain whether a company is buying back their own stock. In this case, they bought back a lot of stock. Were they buying it back when it was cheap? Were they buying it back when it was expensive? For example, in 2020 to 2024, they bought back quite a bit of stock. And if you look at their historical graph and go back to the operating earnings graph, you can see, and then add prices to the graph, you can see that they were, probably buying the stock when it was reasonable. I wouldn't want to see them buying stock back here. Now, just as another example, I mentioned Eli Lilly, and I mentioned it earlier in our discussion about being a stock that gets hype and hysteria. And you can see, here's where you have the semaglutide and all these diet drugs coming. You can see that the company's earnings did accelerate dramatically, but the hype was incredible. If you look at a stock like Novartis, for example, or Novo Nordisk, excuse me, and look at it, you get that same hype, and then all of a sudden, we've had a reversion to the mean, or the market coming into reality. And that's one of the things that I'm so proud of Fast Graphs for, is that it lets an investor can buy the stock here and recognize that they're overpaying for it. And if they believe the stock has a lot of momentum, and you're seeing that with AI stocks now, like NVIDIA and others, at least they know whether they're speculating on momentum or whether they're actually buying the stock at an intrinsic value. And to me, that's the critical factor when we're looking at these kind of things. And again, we can draw these kinds of graphs on 80,000 stocks, virtually all U.S., Canada, and most international stocks as well. And we're very proud of the fact that it allows us to do that. Now, we also have some very other powerful features in our tool, but I don't want to just spend this podcast promoting the tool, although I do, but I don't know that would be fair. I think talking about the principles of value investing are equally important. All that the tool does, in my opinion, is it reflects, the reality of how value investing actually works. For example, if I looked at a stock like Ameriprise, you get this almost quintessential example of how price, correlates to earnings. And the idea that markets misprice stocks is something that I believe true investors need to embrace as investors. They have to recognize that the market can, fear and greed are the emotions that drive market prices in the short run. In the long run, and I define the long run as a business cycle, 3 to 5 years as a minimum. Warren Buffett, again, I'm quoting him a lot here in this podcast, but Warren Buffett, said that, the best, holding period is forever or permanently, if you identify a great business that you want to own. But you've also got to recognize that, you will get, you can't always just rely on PE ratios. For example, if you look at a stock like Pitney Bowes, you could have bought it at very low PE ratios, but what you had was a company whose earnings were collapsing. And this was the old stamp company. They made stamp meters that, everybody has email today. So the stamp business went out of business or became a very poor business. And the company's earnings fell from, mid $2 down to 82 cents a share. Now, there is some things they're doing to try to grow again. But the reality is, if you bought and held this stock, I'm a believer in the buy and hold investment strategy, but you got to buy and hold a business that has, sound fundamentals, that is actually producing earnings growth and growing those earnings, effectively over time. But you can also look at cyclical stocks. You look at a stock like Cummins as an example, and you'll see that they have some semi-cyclical earnings. But once again, you see this, I consider it anyway, a very profound relationship between earnings and market price. And I can instantly identify whether, I'm paying a premium value or not. But by the way, you can overpay for a stock that's growing, even cyclical like Cummins here, where you paid a 20 multiple for it, and you'd still be able to make a lot of money. But yet, you'd make an 8.5% rate of return. But interestingly enough, if you'd have waited just a short period of time to where the stock came into intrinsic value and invest in it, you turn your rate of return into over 10%. And if people understand the power of compounding, the difference between 8% and 10% is a heck of a lot more than 2%. It's a very powerful force compounding it. So, trying to buy stocks at intrinsic value is really, in my view, the holy grail of the value investor. And when you're looking at slow growing stocks, like if you looked at a Campbell Soup, for example, which has earnings growth of 2.5%, you can really see how important valuation is. I like to say, and I say it on my YouTube channel all the time, value matters, valuation matters, and it matters a lot. Like, for whatever reason, people got excited about Campbell Soup here. Now, they did have a good year of earnings here, where they had a 20% growth. But this is a soup company, it's not Apple or Microsoft. And if you'd have bought the stock here, the company still made money all this time. But, as an investor, if you were a long-term investor, you'd have lost half your money owning the stock from 2016. And even if you bought this stock at fair value or close to it, and even measured it to fair value, don't even measure it undervalued, you're going to make the earnings growth rate plus the dividend, and the dividend yield, which we also have an overlay that shows us what the dividends were at that point in time. So back, if you'd have bought it where I hit this angle, you were probably getting a dividend yield of about 3%, somewhere 2.5% to 3%. So that explains the 4%. You got, 2.5% growth plus the dividend, but you also had a lot of cyclicality there. So I'm starting to ramble. How about you give me another question I can respond to?
I mean, this is a very detailed tool. How, how did you build it? Did you build it yourself? You had a team of people building it?
No, we have a development team. My son Colton, who was in here helping me get set up here, as I said, we lost power in our office. I'm sitting here in my home office now trying to do this without the proper tools, by the way. But yes, we have a development team that basically programs this, and we buy our data from FactSet, which is next to Standard and Poor's, the largest data producer, and then we simply create our logarithms, our algorithms, and our formulas, and we use three formulas to evaluate stocks. All of our formulas are at one level, I'm going to call a version of discounted cash flow analysis. Because any business, any asset, in my opinion, gets its value from the amount of cash flow it's capable of generating on its stakeholders or shareholders' behalf. And so the more cash flow a company is able to generate in the future after you buy it, the better your returns are going to be. And so Peter Lynch coined and if you look at a stock like Apple as an example, I'll take a long-term view. I'll just keep it short. Apple historically has grown earnings by over 32%. Okay, so Peter Lynch in his book One Up on Wall Street, used the formula and he does this for fast-growing companies that grow at 15% a year or better. He said PE equals growth rate. You were getting value for a growth stock when you were buying it at a PE ratio that equaled its growth rate. So here you've got a PE ratio line that's drawn at a 32.69 multiple. You can see that by the orange pop up there. And you can see that the stock price tracked that. But Fast Graphs is also dynamic. If you shorten the time frame, Apple is now a $3.17 trillion company. Let's just say that's a big company. Okay, if you look at it, the last 10 years, that growth rate has shrunken to 14%. So you still had this correlation. Now you're drawing the PE ratio at a 15 PE as fair value, and this simply indicates that Apple stock has now become overvalued. And so investors that are buying Apple here, now again, you could have still paid a 34 PE or 29 PE for it back in the September of 2020, and you'd still be making money at almost 16% a year. But what you're really seeing here is an expression of risk. There's a lot of risk there because this company can't grow at 30% anymore. It's just too big. Just common sense would tell you that. And so when you're looking at stocks, you want to focus on what the forecast growth is. Like, for example, this was a stock that was in the news quite a bit in the last year or so. And it's obviously a very strong growth rate. And this company essentially builds storage, machines and everything to support AI. And NVIDIA is a big customer of theirs. And if you look at their maximum time frame, I want you to note, and you can use fast graphs like this. You can scroll this data out, and here was a company that was growing at 10 or 11%. And again, you can see that the stock price correlated to that more use very closely. You can see undervalued periods, overvalued periods. But then along came AI, and AI all of a sudden, ratcheted. In fact, if we look at the last, say, 9 years or even last 6 years, AI, really burgeoned the growth here, and the growth rate just really exploded. Now, this company ran into a problem. They had to change auditors. Their auditors resigned. They wouldn't validate their financial statements, and there was a lot of stuff going on. They eventually cleared that all up, and the stock now is looking like a growth stock again. And the analysts, there are 17 analysts, are forecasting we'll call it 34%, 33.8% growth going forward. So using the P equals earnings growth rate formula, that would imply the stock is a screaming bargain. But I also want to point out that when you look at an analyst scorecard here, they missed it a lot more than we saw with Elevance, for example. And the other thing I want to point out is when you're dealing with super growth like this, super growth is very, very hard to achieve, number one. And competition is going to come in, and this is a $30 billion company. At some point, the law of large numbers comes into effect, and it becomes harder and harder to grow at very fast rates. A good example of that would be Ray Kroc bought McDonald's when he did, and I can't remember the year now, but they had 4 restaurants. He bought it from McDonald's Brothers in California. And I think today he's got 40 to 60,000. I don't even know the number. Well, obviously, when he first bought the company, if he built 2 more restaurants, he had 50% growth, just keeping the math simple. If he built 4 restaurants, he had 100% growth. It's pretty easy to go from 4 to 8, but to go from 60,000 to 120,000, is obviously a massive stretch. And that's what happens to companies. So as companies, grow and they get bigger and bigger and bigger, it gets harder and harder for them to achieve high growth rates. But a lot of times what happens with these companies is that they will live on their reputation. Apple was a good example I showed a minute ago. The company did grow at an unbelievable rate for many, many years, even decades. But now that it's become huge, it's much harder for it to continue to achieve that kind of growth. And that's also problematic to those companies. That's why a lot of these companies, even stocks like Microsoft, which I consider a very overvalued stock today, and if not one of the best companies in the world, it's one of the only 2 AAA rated companies, in the world that I know of, and it's traded at a very, very high valuation, but it did achieve very solid double-digit growth. But the market has been valuing this stock using the blue line in this graph at a very high multiple, and you can see it's trading at an extremely high multiple. And there are just so many examples of companies that did this in the past. I showed you the Novo Nordisk. Here's PayPal that had this parabolic advance, and then all of a sudden we have 1 year of down earnings after they'd grown earnings at 16, 27, 27, 28, 25, and then boom, they have a 10% down year. Still, I think this, if you look just backwards here, this is probably the second most profitable year they ever had in their history. But their stock price, collapses from, $290 a share, ultimately down to, $50 a share, and it's now trading at around 75. It's now tracking its earnings very nicely. It probably looks like a reasonable investment, assuming that the company is still able to grow at about a 12% rate going forward. This would be an example of a stock that is now fairly valued. And so, again, we use this tool as the first step. And what I really am so proud about it is you can look at a company instantly and say, hey, this has been a pure growth stock. There's no dividend. If you look at a stock like Amgen, the largest biotech company in the world, you can see that it was a pure growth stock up until 2011. Then it started paying a dividend. And by the way, we express dividends a couple different ways. We will express this period down here underneath the yellow line is the payout ratio. This is the portion of earnings of these total green shaded area that the company paid out. So we stack it on top. That's just a metaphor to say that, your rate of return is going to be the price moving from point A, like we'll call it here, to point B here. But then that gives you your growth component. And in this case, it was 11.64%. But then it also, this will be on a $10,000 investment, just as a metaphor, and you would have added another 2% almost a year based on the fact that you got the dividend. And the dividend grew every year. And this is a very powerful feature to understand. Now, we produce full performance reports on this tool where you show the company's valuation, we show the dividend, the yield on cost, how much the dividend has grown, what the average dividend growth rate was, etc. And we make it very easy for stock investors to basically manage their portfolio and make decisions. We have a very powerful screening tool where they can go in and screen, and including in that screening tool, we have some preset screen built in. For example, if you're a dividend investor and you were looking at dividend champions, and we're screening for value here, there are 19 dividend champions that would be at fair value. And Becton Dixon's a very interesting example. This company has increased their dividend for 52 years in a row. And you can see that, we only give 20 years on fast graphs. And the market liked to value this stock at a premium. But then all of a sudden now, just in the last year, 6 months, their stock has fallen into a very attractive valuation. Now, at this point, I want to point out there are questions. Now, the market thinks they're going to grow at 6% going forward. Historically, they've grown at around 8%, so the market's expecting a slight slowdown. Analysts analyzing, and there's 12 analysts, analyzing the company. But if this traded at a 15 PE, I always say, to me, you should always run your numbers out to a logical conclusion. I don't think, hope and a prayer is a good way to invest, or wishing you're going to make money. I want to weigh the value of the business and try to understand its value as clearly as I can. And then I want to know that if I buy it at today's valuation, am I going to make money or lose money, and to what extent? So this tool just allows us to do hypothetical what ifs. What if it did earn these earnings, 1464 in 2026, 1592 in 2027, and traded at a 15 multiple? Then as a shareholder buying it today, you can make 17% a year annualized for the next 2.25 years. Now notice this company has a September fiscal year, not a calendar fiscal year. So we're into the fourth quarter on Becton Dixon already. But again, you see this beautiful relationship between earnings and market price. And again, coming out of the recession, this has been a fabulous time. You could have bought almost every stock in the market. That's an exaggeration, but you could have bought it at fair value during those 3 or 4 years coming out of the recession, because you were in an era of pessimism where the emotions were generally pessimistic. And and there are companies, by the way, Pepsi would be another example, very similar to Becton Dixon, which would be another dividend champion or aristocrat. And Pepsi, the market has constantly put a premium valuation. Now that's information, that's knowledge. You have to apply that. So are you willing? Pepsi is a 6% grower. It has a very nice dividend. It's paying over 4% dividend today because the price, normally this trades at a 20, and by the way, these numbers are always ish. They have to be precisely calculated. But if I change time frames, the normal PE of 20.86, for example, changed to 23.5. But it's just for the time frame that I'm measuring the numbers. But the point is, I can look at this graph and say the market likes to apply a 20-ish multiple to Pepsi. And that's probably because of brand, because of the value of their brand. They get a little premium valuation. I don't want to own Pepsi unless it's trading on the orange line. That's being extremely tied into the value investing proposition. It's probably a good value here today, based on the fact if you're looking at it from a normal multiple, concept where the market normally puts, and now this is the normal multiple for the last 5 years. I could also go through here, maybe a more realistic multiple would be something like that 22 multiple. So if the market puts the premium multiple, you can make 18% a year buying Pepsi with a 4% dividend yield. collect a nice dividend for the next 3 or 4 years and get some PE ratio expansion, followed by, just a modest amount of growth, 4% growth. It's not expected to grow. And again, that's not totally inconsistent with a 20-year 6% growth rate. And again, if you change time frames, here's a period where it grew at 5%. Here would be a period where it grew back at 6%. But so the range on Pepsi would be like 4 to 6% in your brain, if you follow me.
Okay. Well, that's a quite nice presentation. So to finish it, if people want to learn more about your education and your tool, where can people find you?
I had Polly send a link to you where you just simply go to the FastGraph website, or you can go to our YouTube channel, and we have a YouTube channel where I produce a lot of videos on using FastGraphs and some tutorials here, and we also have, I sent a link. We are starting a course. I have a PhD who's published numerous articles on value investing, Professor Nathan Mock, and I can never remember the name of the college he teaches at, but he teaches at a major college in Missouri, and he and I, and then my son Colton, who's also got a degree in finance, we're going to be doing a course called Valu-U, and it's going to be a course with live online instruction so that the subscribers to the course can get good information on how to value stocks, how to be a value investor, but then they also get the access to us on a live stream, where they can ask their specific questions and so on. So that's another thing I'd like to plug if I could during this podcast, because we're all about helping the do-it-yourself investor make sounder, more prudent, and less risky long-term investments with their hard-earned money, and also help them track it. Because FastGraphs even generates a stock portfolio performance graph where they can see just how well their portfolios performed, what rate of returns they've earned, and what their top stocks are, and so on. And that would come under our portfolio section, and they could go into the portfolios, and we would look for an advanced portfolio. I'll just bring one up here, and it would show what the rate of return of the portfolio. And this is only on the stocks. If they had cash in the portfolio, it wouldn't be there. But it's a way for them to keep track of their portfolios, and we even allow them to put dots on the stocks where they bought it, so they can keep track of the price they paid for the stock when they bought it, and that's Amazon. So let me go back to America. By the way, Amazon's an interesting company. You always want to value Amazon based on cash flows, but I digress. But here, this particular investor bought this stock on, if I can click it, on May 8th, and he paid $125 a share. And through yesterday's close, this position is earning him 33% a year, 32% growth plus dividends. And you can see that on every stock in your portfolio. So it also allows you to, see what kind of decisions you've made. Here they bought Avgo. This was the AI play. And Avgo, as you can see, was a blue line stock, I called it. And then he did sell half his position here. But, it allows the subscriber to basically keep track of their investments and see how well they're doing. Here's Bristol Myers, which had an earnings collapse. Here's Borg Warner, which is a very cyclical company, and so on. So there's a whole lot to FastGraphs, and it's I call it the value investor's best friend. Of course, I'm prejudiced, I'm biased as the creator and co-founder of the tool.
Okay, well, thank you very much for doing this presentation.
My pleasure. I appreciate you having me on, and I hope you found it valuable.